Well, post-Thanksgiving markets are back in risk-off mode this morning. Equities seemingly stuck between possible Federal Reserve dovishness and the risk aversion signals being sent by the crypto markets. Joining me now, Steve Sosnick, Interactive Brokers Chief Strategist. Steve, it's great to see you. Thanks for being with us. Hope you had a great holiday. Let's talk about the sort of push and pull in the markets here because, we're getting these signals that maybe Kevin Hassett's going to be the next leader of the Fed. The markets are pricing in a rate cut coming up. But then, crypto selling off on the other side. You got this risk aversion. What's going on here?
Well, good morning, Julie. Happy Monday, and I hope you had a good Thanksgiving as well. There are a lot of cross currents. I think, today, I think, first of all, it's hard to sort of take last week as too much of a starting point because we really went up on very light volume. Essentially, this morning, we're giving back Friday's gains. And while I've gotten a lot of questions this morning from people about why are we down so much, not a single person asked me on Friday, why are we rallying mysteriously on no volume? We're supposed to. It's the end of the month. There was window dressing. It was a half day. Don't short adult tape, et cetera. But now we're just sort of giving that back a little bit. Obviously, the Bitcoin story is a bit more notable. And I have been noting that to a certain extent, algorithms are trading off of Bitcoin as a proxy for risk aversion or risk sentiment. And right now, the risk sentiment kind of fell right out of bed today. The proximate cause there was a big backup in Japanese bond yields, a big rise in the price of the yen. That makes the carry trade harder to come by because a lot of people use yen to finance other investments. And it's all, it all sort of spirals upon itself. But I'm not going to read too much into it right now, again, because so much of this was built off of a light volume rally in a whole bunch of assets.
Fair enough. And, people are back from Thanksgiving, but maybe, not seeing huge volumes necessarily here as we sort of get back underway. And so as you look at the outlook for rates, though, do you think that any positivity that comes if the Fed confirms and actually cuts rates, is that already priced into markets or not because we've been seeing things sell off recently?
I think we have been pricing that in, and I think the rally that we saw, again, I discounted last week to a certain extent, but the rally began a couple of days prior, and the rally began as Fed funds expectations improved, and that actually is a pretty healthy reason for a rally. We went from, call it 30% to over 80% in a fairly short period of time. That's a big rejiggering of Fed rate expectations, and it's also no coincidence that the last high in the S&P 500 was basically was literally coincided with the last FOMC meeting, at which point, Chair Powell threw some cold water on the idea of expecting a pattern of rate cuts going forward. And so I think we are repricing along that end. I think, you alluded to the Kevin Hassett story. I'll have to see. I'm going to watch the 10 years and some of the longer term instruments because if he is hewing to sort of the president's model of lower rates, forever, so to speak, I think people will start to get concerned about a rekindling of inflation and inflation expectations because you can't necessarily have both. But I think right now, the market is just more enamored with basically, as I mentioned, the algorithms are trading off of Bitcoin. They're also trading off of the probability of a cut at the next meeting.
Right. And let's talk about AI too. I mean, I just mentioned a moment ago a couple of new AI headlines this morning. NVIDIA buying $2 billion worth of Synopsys, OpenAI now signing on Accenture partnership there, which is sort of like almost a daily occurrence, these kinds of headlines at this point. Is there just sort of a law of diminishing returns? I mean, where is the enthusiasm for the AI trade right now? Is it just in temporary hiding?
I think in some regards it is. I think there's been much more of a reassessment of whether AI is bringing bottom line efficiencies to the end users, not just to the producers of the chips and the hardware, not just to the hyperscalers. Certainly the rally in Accenture that you alluded to earlier is based off of that premise, although it does sort of have a little reminiscent sense, it's a little bit reminiscent of sort of 1999 or 2000, when companies would get a 5% bump because they announced they were beginning a website. So I still want to make sure that this is producing bottom line results. I think the market is getting a bit more discriminating in that regard, which is a good thing because, quite frankly, if you're spending money or investing money, you really should be paying attention to what the end results of that investment are. But I think some of the bloom is off the rose, but I still think the mentality is still behind the AI trade because, quite frankly, it needs to be because it's such a dominant force in the market right now.
And just real quickly, Steve, between now and the end of the year, any big catalysts that you would be looking for? I mean, is it just the Fed meeting? Is it Oracle earnings? Like, what are you watching?
Well, will be the Fed meeting. It will be sort of the data dump, so to speak, as we start to get data coming in. It'll be delayed, but I think we're going to start to get a better picture. And then, you get back into the low volume period, and I think that sort of becomes the focus in and of itself because people, again, it's just after 9 o'clock on Monday morning, and I've already gotten several questions about seasonality and Santa Claus rallies and things of that nature. So I think there's a lot of that baked in, and those are really going to be the main catalysts, I think.
All right, great to see you, Steve. Thanks so much for joining us.
Thanks, Julie.